On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
With all of the global uncertainty, the market sentiment is indicating that the US Fed may be at the end of its rate-raising cycle. Well, my next guest says that even if the Fed does pivot, with interest rates having been this high for this long, we are still likely to see a major credit event that will be a watershed moment for markets, and that a massive liquidity dump awaits, which is bullish for both gold and for Bitcoin. He's also warning about the US debt spiral, which can only get worse, with even Fed Chair Jerome Powell now unequivocally stating last week that the US fiscal path is unsustainable. James Lavish is a managing partner at the Bitcoin Opportunity Fund, which is a hybrid investment fund that makes public and private investments in the Bitcoin ecosystem. And James is also the author of the Informationist newsletter. James, good to have you back with us here on Kitco.
It's great to be here, Michelle. Thank you for having me.
All right. Well, James, I do want to get your macro thesis and also get your insight on the bond markets. There have been some very interesting developments there, with billionaire investor Bill Ackman announcing that he's ending his bearish bet on long-term treasuries. And also want to get your thoughts on some interesting developments in the Bitcoin space and what that could mean for the potential price of Bitcoin next year. But before we do that, and before we get your thoughts on the macro picture at large, I want to get into what we're seeing again from the bond market, because in your newsletter, you break down concepts very, very clearly. So I want you to help our viewers understand what the 10-year US Treasury yield has been signaling, because it recently surged past the 5% mark on yields. The first time since 2007 that 10-year US Treasuries were yielding 5%. It did pull back shortly afterwards, and that reversal may be partly undue to what we heard from billionaire investor Bill Ackman announcing that he's ending his bearish bet on long-term treasuries. But before we get into that, give us a brief overview of the significance of the 10-year US Treasury yield. What does it mean when it surpasses that 5% threshold?
Well, I mean, so if you look at the yield curve, what we're talking about is the 10-year US Treasury it's the benchmark bond for not just the United States, but basically for the world. Being the global reserve asset, the US Treasury, the 10-year is really what everyone looks at as kind of where your levels are for interest rates and yields. And so one of the issues we've seen here is over the last year and a half, we've seen that 10-year yield has come down so much that it's below what the short term is. And so and when that happens, you have what's called a yield curve inversion. And that just means that the market is expecting the yields to come down, right? So it's expecting that we're going to go into a recession, that the Fed is going to pivot, they're going to lower yields. And so the 10-year is sitting low. Now, what we've seen over the last number of weeks is that the 10-year yield, the yield has jumped up in price. Or has jumped up in a level that's gotten up to today, it touched 5%. Why is that a big deal? Well, it's a big deal because of what you said right at the beginning, is that people are expecting that the Fed is going to pivot soon. If you look at the Fed futures and how these are traded, you can see that there's virtually a 0% probability that's being attached to the Fed raising rates in November, a maybe 25% probability that they raise in December. And then if you look at the yield curve on the Fed futures into next year, it's showing that the Fed is expected to lower rates. So why would the 10-year be going up? It makes no sense, unless it's because the investors are now seeing that the Treasury has dumped $2 trillion of debt onto the market over the last 3 months. In the last just 3 weeks, they dumped $600 billion of debt onto the market. This week, they're going to dump another $130 billion of debt onto the market. So what are we seeing? We're seeing investors pull back and say, wait, hold on. That's too much debt. There's no way that we can keep up with this. The deficits are growing so rapidly that you're issuing all this debt And I want to be compensated for what's likely to be inflation in the future, because there's no way that the Treasury can manage that without having nominal GDP, meaning just regular prices without inflation, high enough that the tax base is high enough to start paying down that debt in the future. That's the basic premise of it. So investors are asking to be compensated for that, and the yields are going up in response.
And just again to clarify for our viewers, yield prices move in opposite direction. Yields move in opposite direction to the price. So if you've got a yield going up, that means that the price for that treasury or for that bond is going down, which signals less demand. Is that fair?
Yeah, that's fair. And so when you hear someone like Bill Ackman saying he's short treasuries, that means he's expecting the price of the treasury to come down and the yield of that treasury to go up, right? So when he comes in today and he says, "Okay, I'm out. I'm not going. I'm covering that trade. I'm buying those bonds to cover that short." What he's saying is he no longer thinks that the risk to the upside of yields, meaning yields rising, he no longer believes that that is greater than the risk of yields collapsing. And so why would he say that? Well, it's clear that with rates this high, at some point they've been held. They Fed moved rates so rapidly that they took them from basically 0% to over 5% on the Fed funds rate in a matter of 18 months. And so doing that, it's just a shock to the system. And that has not been felt yet. And so we're starting to see some cracks in the system, and we're starting to see corporate bankruptcies pick up. They're picking up at the fastest rate as they have since the great financial crisis. And so as that happens, you realize that there's a risk that either we just fall headfirst into a recession, or we end up having some sort of what I call a credit event, where you have a company or some sort of bank or something that has a credit problem that is so big or so far-reaching that it has the danger of what we call contagion, which affects other companies. And if that happens, then you see the whole market, just the bottom drop out, because there's a risk, there's a systemic risk to the whole system. And that's the danger.
Before we get more into that credit event and what your thesis is, I want to focus a little bit more on unpacking what we saw from Bill Ackman, because back in early August, he went full bond vigilante, as you would say. Now, remember, he is the billionaire CEO of Pershing Square, which has about $16 billion of assets under management, more so than that. And he said that the Treasury market was off the rails. He earlier disclosed his short on 30-year Treasuries in August, saying that that put a lot of stress on the bond markets. But now he's reversed that, saying we covered our bond short. There is too much risk in the world to remain short bonds at current long-term rates. The economy is slowing faster than recent data suggests. So what do you make of that?
Yeah, and so what he's saying is, look, it's a different kind of tactic to talk your book publicly, but that's what he does, and so it's what it is. But what he's saying is that he sees enough risk that we fall into a recession, or the effects of all of these rate raises start to kick in, and there's such a lagging effect. Remember, the Fed is always operating in its rearview mirror. And so it's reactionary. They have said they're reactionary. They say that they're doing the best they can with the data that they have. And if you look, and every single time that I hear the Fed say this, it kind of grates on my nerves, because it's frustrating to hear the Fed talk about employment and how there's no employment problem. There's no spike in unemployment, because you don't get a spike in unemployment until a recession actually hits. And so it's too late. That's a measure it's a rear view measure that we shouldn't be looking at. But the point is that we are going to have some sort of dramatic slowdown in the economy. There's just too much. There's too much leverage, and the rates have been raised too quickly for that not to happen, in my opinion. Right. And so I think that Ackman also agrees with that. But remember, this is a trade, right? So exactly what you said, Michelle, is the rates go up, prices come down, and vice versa, right? So if he's short bonds, he's expecting, or he's making the bet that rates will spike. Well, we had a nice spike in rates, and now he's pulling back from that, saying, well, the danger is that the rates drop, the bottom drop out of the rates because the Fed has to pivot quickly, either because of some sort of geopolitical issue that causes economic issues, or a credit event, or we just, as I was saying, we fall headfirst into a recession. So all of those are there are a higher probability of that happening than the bond vigilantes continuing to push these rates higher as they demand more yield because of all the bonds coming to the market.
Right. So with all of this uncertainty, it's unlikely that the Fed can raise into such an uncertain environment. But James, even if the Fed is done, right, you're saying that it's not really going to make a difference because we've had interest rates this high for this long, and because we have so much debt, that we're likely to see that credit event that will be a watershed moment for the markets. So now elaborate on what you mean by a potential credit event.
Yeah, so we had a credit event in the it was a interest rate driven credit event in the spring when Silicon Valley Bank when they went under, and that was because they were exposed to the interest rates in a way that exposed their depositors. And so that was a large event that could have been far-reaching with all the VCs and private equity money that was in that bank. That could have been problematic for many companies. And so that's something that could have had contagion. The classic credit events that we talk about are like long-term capital management. And we were talking about this before the show, is that, look, in 1997, long-term capital management was so levered that they caused a virtual meltdown overnight that they had to be saved by the New York Fed. That's a credit event. The great financial crisis was a massive credit event that was far-reaching. We've kicked this up to the sovereign level. So my fear is that we have so much debt on our books, and the debt to GDP levels are so high in the developed nations now that this credit event will push more debt up to the sovereigns in some way, shape, or form. We saw it going back to the bank crisis in the spring in Silicon Valley. Is that they took that situation, the Fed and the Treasury, and they determined that it was so important to shore up confidence in U.S. banks that they created this program called the BTFP, right? The Bank Term Funding Program. And that is quasi QE, by allowing banks to park treasuries at the Fed and get full redemption from them until they have to pay that money back, and not take the market prices of them. That's capital dumping into the market that wasn't there, that wasn't being accounted for, and so that wasn't available. And so it's things like that's the type of thing where it's unseen, it's unexpected, and it's an event that it could just be a washout that the Fed and the Treasury have to step in and push liquidity into the markets. And of course, Michelle, the ultimate liquidity event would be dysfunction in the Treasury market. And we have seen some signals that the Treasury market isn't 100% healthy. And what I mean by that is that when you look at the Treasury auctions, there are little signs that you can see that, there's not quite as much demand at the prices that the Treasury hopes for. And so you're seeing that there could be situations, and I don't want people to think that people shouldn't freak out and think that the Treasury market's going to lock up, that it's going to go no bid, because that would be catastrophic for the entire financial world. But when the Treasury sees signs like this, they know that they're getting close to the point where they can't raise rates anymore. They hope the vigilantes don't force rates higher, and they're concerned that they'll have to step in and do what's called yield curve control and have the Fed enter the markets and start buying in the open market again. And that's the big concern.
What does this growing geopolitical risk mean in terms of the Treasury market? Because typically, Treasuries are a flight to safety. People still see them as a safe haven, especially when things get more and more uncertain on the global stage. We do have escalating global tensions with a conflict between Israel and Hamas, which may have spillover effects. We certainly still have the war with Russia and Ukraine going on. If those geopolitical tensions continue to inflame, is that a potential positive for the US Treasury market? And if so, what impact would that have?
Well, you would think so, right? Because in typically, like you said, the U.S. Treasury is the global reserve asset and it's the ultimate flight to safety asset. However, this situation is a little bit different. We have, and I wrote about this, ironically, I wrote about the Strategic Petroleum Reserve, SPR, the day before the war broke out in Israel. And it was just ironic that that's when I wrote it. But my point then, when I was writing about that in the newsletter, was that, look, we've used this SPR, the Strategic Petroleum Reserve, we've used it as a way to keep inflation in check, right? By selling down the SPR, we've held down energy prices here, oil and gas prices in the U.S., and we've kind of kept inflation in check. And you can see how they've moved together. Well, we've drawn that down by almost 200 million barrels. And so now we have, if you look at the SPR, where it stands now compared to where it was when we built it up. Now, remember, we built up this SPR in the first oil crisis. And when was that? That was back in 1973. And that was the same, it was in the same region, and it was known as the first oil shock. And I was I was a baby here, but I do remember how painful it was sitting in the car waiting for gas in late 70s, early 80s, because we were being rationed oil and gas. And so we built up this SPR to prevent that. But now we've drawn it down so severely that we have 17 days left in the reserve. So if we have a shock to the system in the oil prices and distribution of oil, then we don't have that SPR to kind of to cushion that shock for us in any way like we would have had, right? So we only have 17 days of reserve left for the entire country. But that means that energy prices could spike. So at the same time that you're seeing a flight to the treasuries, you're also seeing a worry that that inflation in the United States is going to be high. So people are going to want to be, the investors are going to want to be compensated for that. Mm-hmm. So we go back to the bond vigilantes who are demanding a higher yield. So it's unclear exactly what will happen if we do get into an all-out crisis and a world war. And so the bottom line is there's a ton of uncertainty out there. And the fallback position that we've been taught ever since 1987, when Greenspan stepped in and said, we will do anything to shore up the markets back in Black Monday in 1987. Ever since then, we have been taught, conditioned, and we know as investors that the Fed and the Treasury will team up to step in and save the market. And that's the only thing that I can say that is holding up the market right now, that expectation that either we get into recession or we have some sort of global shock, or we have some sort of credit event. But don't worry, the Fed and the Treasury are here to save us.
So what does this mean then for safe haven assets like gold? How are investors then viewing gold and Bitcoin in this environment? Because as you quite rightly point out, there's so much uncertainty in the markets. Equity markets seem to be resilient to this. Bitcoin especially resilient at 31,000 earlier today, but other factors involved in the rise of the Bitcoin price. And gold breached $2,000 an ounce, but has pulled back. How do you equate the uncertainty and the markets seemingly dismissing it so far?
Yeah, well, it's interesting because you do see that flight to safety with gold. And in particular, you've seen that ever since this crisis broke out, or this war broke out, you could see gold kind of sniff out the fact that there's so much uncertainty that this asset that's been around for thousands of years is a place to hide in that time of uncertainty. And so it was interesting to see gold going up at the same time that Treasury yields were going up, right? And so it's unusual for that to happen at the same time that the US dollar is going up. So there's a confluence of factors here. And so I believe that gold is a good safe haven for at least the next number of years as this uncertainty and the Fed printing money plays out. As far as Bitcoin goes, well, that's just kind of another question altogether. As much as I want it to be and believe it should be a safe haven, I do believe it's a safe haven long term. In the next year, I can't say that I believe that this is going to be the ultimate safe haven in the next 2 months, 6 months. I don't know. It's still very volatile. There's just not enough money in it yet. I do believe it will get there. Ultimately, it will be the ultimate safe haven, and it will be the ultimate asset to hedge yourself against massive money printing. But I do believe today what we're seeing is not unreasonable speculation or exuberance around the probability that there's a spot ETF that's approved soon, whether it's by the end of the year or early next year. We're talking 10, 12 weeks that people are starting to expect that and that in and of itself is a major driver of assets to this asset. So people will be moving out of certain things, long bonds, and into something like Bitcoin as this becomes a separate class of an asset class.
Right. I mean, it's still to be determined whether Bitcoin will prove to be a safe haven asset if this geopolitical crisis does spiral, which we hope it doesn't. But it's interesting, you mentioned BlackRock, and it's interesting that Larry Fink, the CEO of BlackRock, the world's largest asset manager, he's been speaking quite a bit about Bitcoin lately, and he recently said that the rally we've seen in Bitcoin was about a flight to quality with all the issues happening around the world. But let's unpack this idea of the spot Bitcoin ETF potentially being approved. So it seems as though the consensus is that we will definitely be getting one by 2024. Now, granted, there's no definite, but JP Morgan is now forecasting that the SEC is likely to approve a spot Bitcoin ETF within the next few months, probably before January 10th. What do you think? Is that a realistic timeline?
I do. I think it's a realistic timeline. And in reality, Gary Gensler hasn't really had, in my mind, he hasn't had reasonable, defense for not allowing the spot Bitcoin ETF to be approved to this date. And so, but when you have large, massive players who have between the two of them, tens of trillions of dollars of assets between BlackRock and Fidelity, it's tremendous pressure on them all to figure it out, because it's saying that the people want this, investors want this, they want this easy version of Bitcoin for them to be able to buy and sell in their portfolios. And why it's so important is, I've talked about this before, is that, look, it's very difficult for small institutions and even some large institutions to buy and own Bitcoin. It's a very large, it's a tall hurdle for them to get over in their own operations, right? Because there are legal issues, there are settlement issues, you've got to, who's going to custody the Bitcoin, where's it going to trade, how are they going to market? There's a lot of issues they have to work out, and it's easy for you or me to just go into Coinbase, buy some, put it in a wallet, no problem. But for the institution, it's much more problematic, and it's a larger question for them. So what does this ETF do? Well, it translates Bitcoin into the securities language that they already know and speak, and they do business in every day. They can buy it on the New York Stock Exchange. They can settle it on the New York Stock Exchange. They can have their prime broker custody it, and they can margin against it if they need to with cash. And it's all right there. There's no difference between that and owning a spider for them. And so that's what's important. And so that in and of itself will bring, in my opinion, a tremendous amount of liquidity into this asset. It becomes so easy to buy.
Well, yeah, I mean, BlackRock on its own has $10 trillion of assets under management. The combined assets under management of some of the biggest players is $19 trillion. Now, of course, not all of that is going to go into Bitcoin. But when you look at those numbers, it does indicate that it's very positive for the price of Bitcoin. Whether it's positive for the overall mission of Bitcoin, that's another topic that I'll get into with you in a minute. But let's talk about what you expect in terms of price appreciation for Bitcoin on the news that this gets approved.
Oh, it's Bitcoin. So, and it's anybody's guess, but I do believe that what we saw last week when there was a rumor that BlackRock's ETF had been approved, and you saw Bitcoin just jump in price. It was about 10%, I think, in a matter of minutes, right? So that in and of itself is an indication that there's pent up demand for this, and they know it. And so even if a lot of that was short covering, it shows that we know that this is news that everybody's waiting on. I do not believe that this news is priced into the Bitcoin market yet. It's starting to get priced in today, as you saw, and I believe it will continue to do this. Of course, it's going to react to what's going on in the economy and market as well. It is still considered a risk asset for many holders. And so until we get through that period, it's hard to tell. But I do believe that once we have the 3 main or 4 main ETFs approved, that the spot ETFs approved, that there's going the market value of Bitcoin could double very quickly. And I don't think that would not be a surprise to me at all. It would actually surprise me if we don't double, or at least have some sort of major 50, 60, 70% move on the actual approval of a number of those.
Right. On the news of just having the spot Bitcoin ETF approved. James, what in the macroeconomic world could mute that? If we do have bigger geopolitical risks flaring, and we do have more indications of a looming recession in the United States, and perhaps a change of tune from the Fed, would that significantly mute a positive price appreciation on the news of a spot Bitcoin ETF, or is it still going to happen?
Well, I do think it could mute it in a way. It depends on what the economic situation actually is, right? So did we have a credit event like I was talking about, that we have just this V-shaped sell-off and a recovery because the Fed and Treasury jump in to liquidate the market, or provide liquidity to the market? Or is it something more along the lines of a long drawn-out deep recession that just weighs on the economy for years and years, especially if we are still experiencing some stagflation at the front end of that? That could be a problem. And so that could weigh on it. But that's a longer term kind of event that it's difficult to price out today, but it could weigh on that top end of it for sure. So it really depends on what we're talking about. If we have a recession that's deep enough that your unemployment jumps over 10, 15%, like if we have something that would be like Great Depression kind of event, that would absolutely weigh on every asset. So whether it's Bitcoin or it's stocks, it would be difficult to that would be a very difficult environment to make money in, truthfully.
Right. Now, for an investor that is interested in Bitcoin but has been reluctant to get in because barrier of entry is a little bit challenging with self-custody, getting familiar with the space, what are the potential risks, though, that come with investing in a Bitcoin spot ETF as opposed to buying Bitcoin directly?
Well, it really depends. We've seen problems with spot ETFs for gold. And the problem is it's difficult to audit the gold in their vault and determine that whoever is sponsoring that ETF holds enough gold that if you wanted to transfer your certificate for the gold and take custody of the gold, we don't know that. We've seen there are problems that it may or may not be there. It may have been rehypothecated. It may have been lent out. Now, the difference with a Bitcoin ETF, as long as it is clearly delineated this way, and the end of the final ETF that is approved is shown that it will be able to be audited simply and show exactly where these addresses of every single Bitcoin it owns is, and that it hasn't been moved or rehypothecated, that it is sitting there exactly where in the wallets they say it is, or in that institutional custody they say it is, then it's different. That it won't have the same risk in my mind that you would with a gold ETF, for instance. Now, that said, we all know as Bitcoiners that there is nothing that beats buying and holding Bitcoin in your own wallet and knowing the address and your keys yourself. There's nothing that trumps that. As long as you keep hold of those keys, you memorize them, whatever you need to do, that is the only way that you can ensure 100% that your Bitcoin won't disappear. Because in reality, if you have an ETF, it's still somewhat of a paper market in that you have counterparties. You have BlackRock that's actually holding it, and you have to trust that BlackRock is holding it and that their custodian, if they're not using self-custody, or if they don't have insurance on it through Lloyd's of London or whatever it is, that it is there for you. So there's always that question, always. And
right.
You'll never be 100% sure. But I can tell you this, Michelle, if you're an institution and you're staring down the career risk of buying and holding Bitcoin yourself in wallets that you've created with your internal process, that's going to be a much, much larger, taller hurdle to get over than just simply buying an ETF just like you would buy GLD. It's so much easier. It will bring in money from that world that it's just not available right now. If you're a registered investment advisor, you likely cannot do it for the base of your investors.
And as you said, James, so much about Bitcoin is about agency and self-determination. And that's why holding your own Bitcoin is ultimately the best way to proceed, and the way that arguably Satoshi Nakamoto intended. And it's kind of interesting because we got a quote supposedly from Larry Fink, according to Mike Alfred, the value investor, saying that Larry Fink said that he sees Bitcoin's future value as being synonymous with the idea of human freedom. Now, this is according to something that Mike Alfred posted on X, and he says the following. Last week, I spoke with BlackRock CEO Larry Fink. It was a nice conversation lasting about 15 minutes. At the end, I asked him how valuable he thinks Bitcoin can be in the future. His answer came in the form of a question: what is the value of human freedom? Bullish. Okay, so obviously this is a very big change in tune from Larry Fink, who initially said that Bitcoin was essentially an index for money laundering. Assuming this is an accurate quote, what do you make of this? I mean, what do you make of Mike Alfred saying this, and what do you make of Larry Fink supposedly saying this?
I haven't talked to. I know Mike, and I've tried to reach out and see how accurate this statement is. And I love, and I don't know Larry Fink, but he's correct. The bottom line is, he's saying this at this very same time that you have Christine Lagarde announcing the on-ramp of CBDCs out in Europe. And so that's not lost on either Mike or me, right? So the significance of this statement is that Bitcoin is the exact opposite of a CBDC. And that's the real point of all of this, in that you've got fiat that's troubled, that we're seeing is troubled. You've got endless amounts of debt that are coming into the market that are making every single dollar currency out there, whether it's the yen or the euro or whatever it is, every sovereign that is printing their own money and issuing their own debt, their currencies are becoming less valuable. You've got that problem. Then you've got the CBDC problem, where you have the European Commission saying that they're going to issue, it's just a digital currency. It's no different than what you've been using all along. That's a flat out lie. Of course it's different. And it's going to have restrictions for certain uses and for people in the future, in that you will not be able to use your money freely. That's not freedom. When you expend your energy and you store that energy in the form of money in order to use it later, that's freedom, as long as you can trust the money. But if you can't trust the money, then you can't trust the freedom. And I think that's the real crux of all of this. And that's the interesting part. And if Larry really believes that, and he really understands that, then BlackRock they're in the position to bring Bitcoin to a much wider audience, and that's the key to the whole ETF.
Do you think, and I'm asking you to speculate here and go into the mind of Larry Fink, but do you think that his change of tune on Bitcoin may be linked to the idea of CBDCs also posing a threat to traditional institutions?
I think Larry's change of tune and heart on the ETF and Bitcoin has to do with profits. Okay. I mean, that's just, as much as I wish it would, as much as I wish that he is a true believer and he understands that Bitcoin stands for freedom. I think it's more ironic that he said that at the same time that Christine was saying the other thing, because pushing CBDCs, because when you look at the landscape of the major investors and the major businessmen of this nation, and you look at the Jamie Dimons of the world, and you look at the Warren Buffetts of the world, they're not looking at Bitcoin as something that they can profit off of. It's disruptive to their businesses. It's disruptive to the things they've been doing and the way they've made money for decades and decades. But Larry Fink sees a different path. He sees a path as BlackRock, that he can create something that can benefit not just the market, but BlackRock in the form of large profits, because he sees pent-up demand. And that's really the big key here. He sees this pent-up demand for this product, and the market is ready for it and asking for it. And that's what he wants.
Are you concerned that, given that it is BlackRock, that there will be, in a way, centralization of custody of Bitcoin with these big institutions, that impacts the decentralized mission and ethos of Bitcoin?
Oh, that's interesting, that you asked that, Michelle. And the answer is it could be problematic to have one custody solution, and have one place that is in control of everything. But that really depends on the structure of that. And there are a lot of solutions out there that I believe are getting to the point where they minimize and there's no way to eliminate, but they come close to eliminating those types of risks. And so, as you mentioned at the beginning of the call, I'm one of the managing partners of the Bitcoin Opportunity Fund, and we're looking at companies that do just that manage risk around custody and provide insurance solutions around that. And so we've just invested in a company that is working on that, and those are the kinds of things we're looking for. So any way you shape it, any way you cut it, I'm super optimistic about the future of Bitcoin and investing in that ecosystem, because these products are coming to market. The demand is there. It will eventually tip over into a safe haven asset or just a completely separate asset class that's uncorrelated to the risk market. And so I am extremely optimistic about that. And I see this as a space that's going to grow rapidly and exponentially over the course of the next 10, 15, 20 years. So BlackRock coming into it. One thing I want to say is that when people hear BlackRock and they hear that they have $10 trillion, they think that BlackRock is going to own $10 trillion of Bitcoin. Well, that's not, you know better. I know you do. But for the listeners, BlackRock being involved, it's a business for them, that's the bottom line.
But again, it is then going to be potentially centralized in terms of these big institutions buying so much Bitcoin. Right? It's not going to dedicate its all $10 trillion of assets under management to Bitcoin, but it'll give a little bit of that towards that goal. And if you get Vanguard, if you get Fidelity, if you get some of the other big players approved at the same time and they go into the Bitcoin market, sure, that pops the price up. Sure. But are they then sort of having centralized custody of much of the supply of Bitcoin? And is that necessarily a good thing?
Well, if you look at the landscape now and how custody is done for major institutions now, whether you've got the largest pension funds and endowments, they use prime brokers to custody assets, and they spread that risk out. And I would imagine that they would be doing the same thing here. I hope they do. There's no certainty of that, but they're going to want to spread out their risk as well. They're not going to have, $1 trillion of Bitcoin in a wallet. They're going to have that spread out in many different ways.
So that would count to the centralization idea.
Yeah, I mean, I think that it becomes, like I said, it gets treated like an asset, like any other asset in the world. So if you're looking at the market now, we've got $120 trillion worth of equities, $130 trillion worth of bonds in the world. If Bitcoin becomes a $20 trillion asset, eventually it will, in my opinion. Well, that's just one of those assets, right? And there will be many, many, many owners of that across many different counterparties and custodians.
All right, I want to bring it back a full circle to where we started this conversation. If we do see this credit event that you say is likely, what would that mean for Bitcoin?
Yeah, so the credit event, in my opinion, would be a situation where you have a high probability of contagion from counterparty risk between large banks or large institutions. And so what I mean by that is that it would force a market sell-off in virtually everything, and everything correlates to one. Everything correlates to one when you have that kind of market event. And so the market draws down, and you have this V kind of drawdown on a market event like that. And then the recovery comes when it's not the Fed pivoting, it's the Fed and the Treasury pushing tremendous liquidity into the market to make sure that it doesn't collapse, that we keep the Treasury market liquid, because when everything is said and done, there is the only thing that the Treasury really cares about is making sure that the Treasury market remains liquid so they can keep borrowing. They can keep selling bonds to the world. They need that. That is, and they know, everybody knows that the Treasury market must remain liquid for the entire financial market of the world to continue to operate. And so what I believe is that would mean that they'll do anything to shore up that market, whether it's some sort of new acronym that they create that is stealth QE, or it's outright QE where they print trillions and trillions and trillions of dollars again, and they step into the open market through the dealers and buy those assets on the open market and shore up the market. And that, for me, is a tremendous upside event for gold and Bitcoin. There would be large upside, in my opinion, on that kind of V-shaped recovery.
All right, we will wrap it up there then. Thank you very much, James. Just a quick opportunity to tell our viewers about your newsletter, The Informationist, how they can sign up and how they can read your work.
Yeah. So The Informationist is a newsletter I write every week, and I take one financial topic and simplify it for you. And you can just go to jameslavish.com and sign up there. It's free every single week. And the Bitcoin Opportunity Fund, if you want more information around that, it's still open to some investors. And for accredited investors, unfortunately, that's not my rule. It's the SEC. But if you're interested in that, you can go to bitcoinopportunity.fund, and we can send you information about it.
All right. Well, thank you for helping us demystify some of these topics. I always look forward to your newsletter. James Lavish, appreciate it. Thank you.
Awesome. Thank you, Michelle. We'll see you next time.
We'll see you next time. And again, a special thank you to our sponsor, Swan Bitcoin. Swan does have an IRA product that allows you to invest directly in Bitcoin with your IRA. You can set it up to practically buy Bitcoin on autopilot. There is a link in the description for Kitco viewers that want to check it out. So for me, Michelle Makori, and the rest of the team, thanks for checking out this episode of On the Spot, and we'll see you next time.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. Traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.